Welcome to Let's Talk Money, Honey, the podcast where we break down the barriers to financial success.
I'm Elise Levy here with Holly Henry, and we're your hosts, two financial advisors on a mission to demystify investing, unravel the complexities of money, and sprinkle a little wisdom into your life.
Whether you're a seasoned investor or just dipping your toes into the world of finance, join us once a month as we discuss how to navigate life's financial twists and turns. Just remember, building wealth and living your best life should be empowering, not intimidating.
So listen up and let's talk money, honey. All right, welcome to another episode of Let's Talk Money, Honey. And today we're talking about one of my favorite topics and favorite kind of accounts, Roth IRAs. And full disclosure, this is the second time we're filming this episode because there are so many details with this account. And we went back and we listened to the episode and we thought that it was just a little bit confusing. So this time we're really going through every single part of this account and how it works so our viewers and listeners can really understand it because it's such an important part of a financial plan as you start to build your assets. Right, Holly?
Absolutely. And while again I agree, this is one of my favorite accounts. This is an account that isn't for everyone. And I guess we need to just kind of back up and explain like what is a Roth IRA?
Mhm.
Again, this is a retirement plan, and the differences between it and a traditional IRA is it goes in after tax money. And then when you get to be 59 and a half or whenever you're going to pull the earnings out, everything comes out tax free. That's the bonus of this. This is especially good for the people that chances are going to still be high income earners later in life. And I want to say just right off the bat, I feel like this is like one of the best accounts you can get young people in. And one of the main reasons is, and this is something that Elise and I just can't stress enough, when you put in that money, that principal, the contribution amount, you can pull it out at any time. So, for example, if a 20-year-old comes in and they want to open an account, and their idea is they're going to leave that money in there until they get ready to buy a house, then it can stay 4 years, 8 years, 12 years, and then they can pull the principal out with no tax, no penalties. The catch is those earnings cannot be pulled out. There are the restrictions on the earnings. So, Elise, do you want to go over those restrictions?
Yeah. And like I said, a lot of words being tossed around. And so keeping it really simple, the principal is the money you put in. So if you over your lifetime put in $10,000, that's your principal. And then earnings is what that money makes. So if the account has grown to 20,000, that now 10,000, that's your earnings. And that's what Holly is talking about.
Yes.
And if you get confused, remember, call us. We'll walk you through
Yes.
it.
Yes, absolutely.
Yes. But going off of what Holly was saying, the earnings have their own special rule of when you can take it out. And that is called the 5-year rule. And so no matter how old you are, you can be 20 or you can be 58 and open a Roth IRA. The rules are going to be exactly the same. You have to wait 5 years before pulling out any earnings in a qualified distribution. Why that is, I'm not really sure, but it was a rule made along the way and we have to follow it. And so when I say qualifying distribution, that's your reason for pulling out the money. So I'm going to go over the situations where you actually can pull out that money. So the first one is you're 59 and a half, and like we've gone over, you've had the account open for 5 years. So that's that golden retirement age. Now you're allowed to take that money out and you won't get caused a penalty. The second is a death or a disability that helps you qualify for an exemption. So you have a workplace disability happen, you're allowed to take money out to supplement your income. And then the other exemption you should definitely be aware of is the first time homebuyers exemption, which is really, really great. You can take up to $10,000. It's a one-time lifetime exemption. You can't do it ever again, but you can take out $10,000 out of your Roth IRA earnings and not get charged that 10% penalty. So that's really something awesome to be taken advantage of and to be aware of when you're opening the account. But let's backtrack a little bit. Holly, maybe you can go over the tax deductible features of a Roth IRA versus an IRA, and kind of take it away from there.
Yeah, and I do want to mention, because again, there's a lot that we're discussing, and we are at this point there. We're not going to talk a lot about conversions, which is a whole other Roth conversation. We're just talking about the main basic contributions where you're just putting money into the account. So no rollovers,
Yep.
no any type of conversion conversation in this. Again, when you get to those conversations, just pick up the phone and call us. So those earnings have different rules, and that gets really sticky, really deep, and we're not going to talk about that. So the great thing about a traditional IRA is you can deduct that from your tax. There's tax incentives to that. However, with a Roth IRA, as I mentioned earlier, this is after tax. There's no tax incentive you're going to get from this, unfortunately. The incentive is whenever you pull that money out later, years down the road, you're not paying taxes on it. That's the wonderful thing about it. Is again, for those of you that think that you may be getting a high pension or you've got a large amount that will be coming from a 401k, anything that comes from the Roth that's going to supplement that, you're not going to have to add that to your income. So that is the incentive down the road. There are contribution limits that we need to discuss. And every year these limits go up just a little bit. And so for 2024, it is $7,000 if you're under 50. And then if you are 50 and above, it is $8,000. And
Yeah.
Elise, I know there's income limits. Do you want to discuss that or?
I can talk about that for sure. But I also want to mention you brought up a good point with supplementing a traditional IRA with a Roth IRA. And so I think that's a lot of times when this account comes into play, it is not going to be your only retirement account.
Mhm,
Most likely, it's going to be supplementing
mhm,
either your 401k through your work or an IRA that you've created. And so that's why it's nice to have the post-tax account because chances are you are going to have a pre-tax account as well. And those two options in retirement are just going to serve you really well. And I think, like, for our young investors who are just really eager to save and build wealth, I love saying, like, okay, we're doing your 401k through your work. You're doing 10%, you're doing 50%. Now let's open a Roth IRA and start putting money into that. And so it's
mhm.
just a great place for extra savings for those people that are making money now and want to be saving it. But keep in mind, there are income limits, as Holly mentioned. So these go up every year as well, kind of keeping up with inflation and cost of living. But for 2024, for single filers, if you make over $146,000 a year, you cannot contribute to a Roth IRA in the traditional manner. And for couples filing jointly, that number is 230,000. So if you're above that income limit, it doesn't necessarily count you out. You just have to do a backdoor Roth contribution, which is a couple extra steps. And if that is ringing a bell and you're like, that's me, give Holly and I a call. We'll walk you through the procedures. It is really simple. It's just a couple extra hoops you have to jump through. So that was a lot of information. I feel
Yeah,
like we wanted this to be a mini episode, and now it's a full-fledged episode.
yeah, but I also one thing that we have not discussed is why this may also be so advantageous for the younger adults.
Mhm.
So you got to remember for most young adults, they're going to be in the lower tax bracket, right? These high schoolers that have summer jobs, they're
Yep.
going to be either paying no taxes, maybe 10%, maybe 12%, so very little. So again, take advantage of paying this little after tax amount. And then when it comes out several years later, again, you're not paying taxes on it again. And as we stated earlier, these accounts aren't for everyone. Like there may be certain people that need that tax incentive from a traditional IRA. And this is why it's so important. And I know you're going to hear Elise and I say this a million times. It's so important to just call us and pick up the phone and discuss which one may actually be a better fit for you.
Yeah, 100%. Because every situation is unique and it's something to take advantage of for sure, but it might not be right for every person. And the other thing we kind of think about is we don't necessarily know what the future holds as far as income tax and
Mhm.
what the IRS is going to do moving forward. Holly and I have to stay very apolitical and we stay kind of in the middle, but it is our job to be aware that taxes and taxes can change. And when you have that Roth IRA and you've already paid income taxes, you're also guaranteeing that you won't be affected by what happens tax wise down the road.
Mhm.
Anything else we need to go over? That was a lot.
I mean, I do. I think it's a lot. And again, I think that this is something that most people need to take advantage of, but one on one conversations sometimes it's just the way to go. So again, just reach out and we can go further into detail with you.
Yes, awesome. And remember, principal can be withdrawn at any time. Earnings, 5-year rule. That's all you need to know.
Yes, exactly.
All right. Thanks for listening, everyone. This is our mandatory disclosure statement. Elise Levy with Legacy Wealth Planning in Reno, Nevada. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Mariner Independent Advisor Network, LLC, a registered investment advisor. Mariner Independent Advisor Network, LLC, and Legacy Wealth Planning are separate entities from LPL Financial.
Holly Henry with River Valley Wealth Management near Mena, Arkansas. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC.